All right, let's get right into it. Welcome to today's Daily Brief Explainer. Today, we're tearing down the wall between what the headline writers want you to believe and what the hard, raw market data is actually doing. We're going to look at this incredible algorithmic trap that just got sprung and caught the smart money totally off guard. It's fascinating stuff, so let's just dive right in. You know, we always hear that retail investors are the emotional ones, right? The guys panic selling from their couches. But what if I told you the highly paid fund managers, the folks managing literal billions, just fell hook, line, and sinker for a massive algorithm-driven trap? It happens more than you'd think, and we're going to see exactly how the market makers do it. Section 1. The institutional bear trap. We're zooming in on this very visible panic we saw recently in tech, specifically looking at U.S. fund managers just dumping shares like crazy. And the sheer persistence of this panic is what's really wild here. Think about this. For 8 straight days, 8 consecutive trading sessions leading right up to June 29th, institutional managers just relentlessly dumped tech stocks. I mean, they were mashing the sell button day after day, totally convinced the bottom was falling out of the market's most profitable sector. And we aren't talking about some routine portfolio rebalancing here. This concentrated dumping, mostly in semis, was literally the largest volume of tech sector selling we've seen in an entire decade. 10 years! The algorithms basically bullied these pros, sweeping them totally out of the market and forcing them to liquidate at exactly the wrong moment. Which brings us to Section 2, Anatomy of a Reversal. Let's break down exactly how this trap was set up using the semiconductor ETF, ticker SOXX. So tracking the lows on SXX, the setup becomes pretty obvious. You've got a steady decline through mid-June, hitting 590.6 on the 16th, then a slightly lower low of 586 on the 24th. But the real fireworks? That was June 29th. The price absolutely plummets to 571, looking like it's breaking all support before violently surging right back up to 599. This is a textbook false breakdown. Let's walk through it. Step 1. The algos push the price just below that critical 585 support to trigger everybody's stop losses. Step 2, they drive it all the way down to 571 to squeeze out every last drop of panic selling. Then, step 3, the second the selling dries up and the institutions are flushed out, boom, they rip the price straight upward to 599. Those fund managers were left totally dazed on the sidelines. So where do we go from here? Well, with the institutional sellers cleared out, their shares eaten up and their morale pretty much crushed, that overhead resistance is just gone. The data is now pointing to a highly bullish trajectory. We're looking at next targets in the 640 to 660 range, potentially even grinding up to 700 for July. But this whole illusion isn't just happening in tech. That leads us to Section 3, the macro inflation illusion. Let's shift our focus to the broader economic picture. Look at this absolutely massive disconnect between the narrative and reality. The financial news has been screaming that U.S. bond yields were going to blast past 4.66%, hitting 5% or maybe even 6%. That was the dominant fear narrative. The actual reality? Yields did a total 180 and are actually dropping down toward 4.315%. The panic was completely manufactured. And on top of that, despite this endless drumbeat of runaway inflation, the underlying metrics are saying the exact opposite. Actual inflation expectations are plummeting, and alongside that, the rhythm of U.S. wage growth is clearly slowing down. The inflationary fire everyone is supposed to be terrified of? Yeah, the data says it's aggressively cooling off. Which perfectly segues into Section 4, Fear versus Market Reality. It's so crucial to spot the difference between how people feel and what the market is actually doing. If you check out the CNN Fear and Greed Index right now, it's pretty wild. Retail investors are basically sitting in extreme fear. They're totally paralyzed by negative headlines and crash warnings, just playing defense and waiting for the floor to cave in. But does that panic actually make any sense when you look at the charts? Honestly, no. Because while sentiment is screaming extreme fear, the NYSE composite is quietly hitting historical highs. The Dow marked a new high last week, and the S&P 500 advance/decline line, which is huge for showing broad market participation, just hit a brand new peak. The market is showing immense strength while the crowd is terrified. To really hammer this home, look at this stat. A massive 65% of the individual stocks in the S&P 500 are currently trading above their 200-day moving average. So no, it's not just 3 or 4 mega-cap tech stocks holding up a house of cards. This is broad, systemic strength across the board. The fear narrative just doesn't line up with the math.
So let's move to our final point, Section 5, trading without emotion.
This quote right here is everything. Remove the emotions, let the brain work, and look for risk-reward relationships. When the raw data contradicts the media spin, you have to step out of the trenches. In the markets, emotion is a massive liability. Your best defense against algorithmic traps is just ruthlessly focusing on the objective reality of risk and reward. So, pulling it all together, the institutional bears just got shaken out in a classic false breakdown, inflation and yields are actually cooling, and the broader indices are flashing incredible underlying strength. When you stack all that data up, the probability leans heavily toward a very bullish run for the stock market this July. The smart money took the bait and got swept right off the board. But you've got the real data right in front of you. You can see exactly how the illusion was built. So the only question left to ask yourself is this. Now that you see the trap for what it is, how are you going to position yourself tomorrow? Thanks for hanging out with me for today's explainer, and I'll see you in the next one.